Right now, Pinterest, ticker PINS, is trading live at $26.54, caught in a heavy downdraft, down sharply by over 4.2% on the session. This isn't just a minor pullback, it's a continuation of a brutal post-earnings sell-off. The stock is currently fighting to find a floor, trading in a volatile intraday range between $26.06 and $27.34, and the volume is massive, confirming the market is making a very decisive and very negative statement. The immediate gut punch reaction to this movement is one of confusion. How can a platform that just announced a new record of 600 million monthly active users be falling off a cliff? This is the central puzzle. The expectation, the narrative that has been building for months was that Pinterest had finally turned the corner. The user growth story, especially the capture of the coveted Gen Z demographic, was supposed to be the main event. The reality, delivered cold and hard by Wall Street, is that user counts mean nothing if you can't effectively turn them into profit, and more importantly, promise even more profit tomorrow. The stock is plunging not because the platform is failing, but because its financial performance failed to meet a very specific set of spreadsheet expectations. The common belief about Pinterest is that it's the nice social media site, a digital corkboard for recipes and wedding ideas, a relatively safe haven from the toxic debates seen on other platforms. Investors, particularly those looking for growth, have held on to the belief that this massive, high-intent audience was a coiled spring. They imagined that once CEO Bill Ready perfected the ad tech stack, the revenue would explode. The expectation was that the platform's recent partnership with Amazon and its push into shoppable pins would finally close the massive gap between its average revenue per user in the US and its dismally low international ARPU. The recent earnings report, however, threw a bucket of ice water on that optimism. The reality is that while revenue grew 17% to $1.05 billion, which was in line with forecasts, the earnings per share came in at 38 cents, missing the consensus estimate. Worse than the small EPS miss was the forward guidance. Management guided Q4 revenue to a midpoint that was just shy of what analysts had penciled in. In this market, which is hanging on every forward-looking statement, a guidance miss is a cardinal sin. This is the kind of detail that separates a successful online investment from a painful lesson. Let's break down the recent trading action because it tells the whole story. Before the earnings call, Pins was trading confidently, north of $32 a share. The sentiment was bullish. Analysts were mostly positive, and retail traders using platforms like the Robinhood app were likely piling in, likely using Robinhood fractional shares to get a piece of the expected beat. But the moment those Q3 numbers and, critically, the Q4 guidance hit the wires, the bottom fell out. The stock gapped down over 20% in a single day. This is where you see the stark difference in investor behavior. An algorithm running on an interactive broker's terminal, likely managed by a hedge fund, would have sold in a microsecond based on the guidance miss. This is the world of professional interactive brokers trading, where speed is everything. Meanwhile, a long-term holder checking their Fidelity mobile app to look at their Fidelity IRA's account would have woken up to a massive loss, forcing a very different and more painful decision: hold and hope or sell into the panic. This is the kind of volatility that makes a mockery of simple self-investing strategies and highlights the psychological pressure of a major investment. The stock's current battle around the $26 level is the market trying to figure out if this is a catastrophic failure or an overreaction. Is this a broken company, or is it just a reset of expectations? The volume of shares changing hands suggests institutions are aggressively repricing the stock downwards, dumping positions that were built on the growth at all costs story. They are now demanding profit, and they're not getting it fast enough. The management's explanation for the softness was, frankly, not well received. They pointed to macroeconomic pressures and specifically tariffs impacting the ad spend from large U.S. retailers. To an institutional investor, this can sound like an excuse. They look at a high flyer like Nvidia stock, which has its own complex supply chain narratives, or a behemoth like Apple stock, which navigates global economic currents, and they expect a company like Pinterest to have a better handle on its core market. This isn't Tesla stock, which trades on a completely different set of manufacturing and delivery metrics. This is a digital advertising business. The softness in North America, its most mature and profitable market, is a significant red flag. It suggests that even with 600 million users, the platform's new ad formats and AI-driven shopping tools aren't compelling enough for brands to maintain their budgets in a tougher economic climate. This is where the story gets complex. It's not just about online investing, it's about understanding the deep mechanics of the digital ad market, which is dominated by giants. So, what does Pinterest actually do? For anyone who is new to the name and just looking at investing sites for the first time, Pinterest is not a traditional social network. It's a visual discovery engine. Users come to the platform not to see what their friends did last night, but to plan their future. They search for kitchen remodel ideas, fall outfit inspiration, or workout routines. They pin these ideas to boards, effectively creating a visual wish list. This is the company's entire value proposition. It's a platform built on future commercial intent. Unlike other platforms where ads are an interruption, on Pinterest, a relevant ad can be the solution the user was looking for. This is what makes it so different from its competitors. The company makes its revenue by selling ads to businesses that want to get their products in front of these planners at the exact moment of consideration. This is a powerful model in theory. The company has spent the last 2 years under Bill Reddy completely re-architecting its ad tech stack, moving from a brand awareness platform to a direct response platform, where an advertiser can track a click directly to a sale. This is why the Amazon partnership was so important. It integrated Amazon's massive third-party seller catalog directly into Pinterest, making millions of products shoppable. The past performance of Pin stock has been a roller coaster, a perfect case study for any investment help seminar. It IPO'd in 2019, saw a massive surge during the 2020 stay-at-home boom when everyone was planning home projects, and then crashed spectacularly in 2022 and 2023 as user growth stalled and the ad market dried up. This recent period was supposed to be the grand recovery. And in many ways, the user metrics did recover. Hitting 600 million MAUs is a monumental achievement, especially with Gen Z now making up over 50% of the user base. This is the next generation of consumers, and Pinterest has them. This is the expectation part of the equation, the story that many investors using Fidelity brokerage accounts or even automated Schwab intelligent portfolios bought into. The reality is that this growth has been concentrated in international markets, where ARPU is a fraction of what it is in the US and Canada. The company is adding millions of users that are very difficult to monetize, while its most valuable market, North America, is showing signs of weakness. This is the disconnect. You can have all the users in the world, but if they aren't generating significant profit, Wall Street will punish you. This is why simply picking stocks on a SoFi trading platform because you like the product can be so dangerous. The financials have to support the story. Comment below with your average cost basis on Pinterest stock if you hold it. It's always insightful to see where the community is positioned after a big drop like this. Looking at the future outlook, we are now at a crossroads. The bull case and the bear case have never been clearer. The bulls, perhaps those with a long-term view in Fidelity Wealth Management or those who regularly add to Fidelity ETFs, will say this is a massive overreaction. They will argue that the core thesis is intact. 600 million users, dominated by Gen Z with high commercial intent, is an asset you cannot ignore. They will say that the AI-driven shopping assistant features are still in their early days, and that the international monetization effort will take time, but it will happen. They will see this 20–25% haircut as a generational buying opportunity to get into a long-term growth story. They believe the company is successfully transitioning from a simple ad platform to an e-commerce powerhouse. They will point to the 40% rise in outbound clicks to advertisers as proof the new ad tech is working. They see the SoFi ETFs that hold pins as a smart, diversified way to play this long-term trend. The bears, however, see a very different picture. The bears, possibly short sellers using the sophisticated tools on the Interactive Brokers platform or just looking at the hard numbers, will say the emperor has